A very good morning, everyone. Welcome to this first in our series of three virtual seminar events we're running during January and February on defined benefit, DB, pensions and advice. Thank you for registering for the event. We hope that you and all those close to you are well as the world continues to be a little bit uncertain. But we're very excited to be running these events, having run a similar series in May 2020, back at the height of the first lockdown. So if you join those or give some feedback on those events, very many thanks. The DB pension advice market continues to be the subject of a lot of scrutiny, a lot of change. So we thought it'd be a good idea to reconvene and to run a fresh series of webinars for 2022. My name is Peter Lovegrove. My colleague Rebecca Prestige and I work in Grant Thornton's regulatory advisory practice. Good morning, Rebecca. How are you?
Good morning, Peter. I'm very well. How are you?
Yeah, I'm all right, thank you. Excited to be doing this. So Rebecca and I are both pension transfer specialists, and our team has done a lot of work over the past 2 to 3 years with firms and other industry parties on various aspects of DB pension advice. Just a couple of logistical and housekeeping points that we're all familiar with these days, but bear with me. This is obviously a virtual event. It's being recorded. We're going to distribute it to all those who registered as soon as we can afterwards. And as you'd expect to say, we apologise in advance if there are any unexpected interruptions. We're working remotely still, so if there are disruptions beyond our control, please do forgive us, and thank you for your understanding. We are actually planning to do an in-person workshop, excitingly, at our offices in Finsbury Square in London as soon as we can. Hopefully that's starting to look a little bit more feasible now. Before we get stuck into the first session today, I just want to briefly signpost what we're going to be covering across these 3 sessions, firstly today and then on Wednesdays the 2nd and the 9th of February, all at the same time between 10 and 11. So today, Rebecca and I are going to talk about the current state of the DB pension advice market and what we think the outlook is like for this year in the context of issues surrounding advice given to members of the British Steel Pension Scheme. And the impact of the more recent changes to the FCA's rules and guidance. That's today. Next week, 2nd of February, we're going to go through in quite a detailed way how we think the FCA's defined benefit advice assessment tool, the DBAT, should be used, either when you're giving live advice or indeed if you're reviewing advice given in the past. And then finally, on the 9th of February, so 2 weeks today, we're going to look at what we think are the key components of a compliant, high-quality defined benefit pension advice solution, including, in what scenarios is the transfer more or less likely to be appropriate, and why is that? So that's our sort of agenda for the next 3 weeks or so. So each week, Rebecca and I will have a conversation to explore these topics. But as usual, we would love you to participate. If you have any questions or observations, please submit them via the questions tab in the chat function, and we'll do our best to field as many of those as we can within the end of the session. We're also going to use a couple of instant poll questions dropping in as we go through, so be alert to those, and we'll be grateful if you could participate in those as well. Rebecca, over to you.
Thank you, Peter. So I think we can. I'll just sort of introduce the first session. So if we can move on a slide, thank you. So as Peter mentioned, we're going to explore the DB pension advice process in more detail later on in the sessions. But today we thought we'd set the scene by assessing the current state of the DB pension and advice market and the outlook for 2022, including obviously the impact of more recent changes to FCA rules and guidance for advice in this area. We'll be having a think about the FCA's Dear CEO letter that they issued in December of last year, which signposted a consultation on a Section 404 redress scheme for members of the British Steel Pension Scheme who were advised to transfer out. And in this context, some observations on what firms should be doing now, and obviously some thoughts on governance and controls, some standard things there. So if we could just move on to the next slide, thank you. I think most people tuning into this will know that the DB pensions advice market has changed quite starkly in a short space of time. The pandemic has certainly not helped, but the changes are arguably, we think, mainly due to recent FCA supervision and policy making. In fact, In fact, what's happened in the DB pension advice market in the last few years is a striking an example, as you can imagine, of how powerful the regulator can be when it really does have the bit between its teeth.
Yeah.
So as we'll go on to describe, the DB pension advisory market has contracted significantly. But before we go any further, I think it might be useful if we do a quick sort of scene setting poll question, which if everybody wouldn't mind participating in. So the question's there, so if you or your firm still has the regulatory permission to give DB pension transfer or opt-out advice, do you intend to retain this? So some fairly straightforward answers there, either yes or no, or that you might be considering exiting, or I guess for some of you it won't be applicable, or you're not quite sure. So we'll give a moment or two for some responses to come in there. Okay, well, reassuring. So 63% intend to retain permissions. Hardly anybody here is planning to relinquish their permissions, and I guess for some won't be applicable. So that's quite reassuring, I think, 63%.
That's right. I mean, obviously, this is not scientific. It's a bit of a straw poll, and it's determined by who's participating. But yeah, you're right, that is reassuring. I think one of the messages we're going to come back to later is that there is absolutely a place, an essential place in the financial services advice market for people with the skills and experience necessary to give this advice. So yes, it is really indeed reassuring that there are people wanting to carry on.
Yeah, indeed, that's good. So I wonder, sort of with that backdrop, we can maybe talk about the key features of the current DB pensions advice landscape, particularly given the FCA's latest sort of rule changed in October 2020, and of course the pandemic, hopefully moving now to endemic. What are your thoughts, Peter?
Yes. Okay. Well, I think firstly, I'm going to mention this and then sort of largely park it, I suppose. But it's helpful to mention briefly, perhaps, an elephant in the room, which is the FCA's more recent consumer duty proposals. This looms large over the outlook for 2022 and beyond for any and all firms who have retail customers. So I think what we're talking about today, as a standalone topic, can be considered in the context of a significant contribution towards firms that advise in this area, demonstrating compliance with the new proposed principle and the cross-cutting rules, as well, of course, as all the more specific rules and guidance that we already have in this particular area. I think perhaps consumer duty is a whole webinar, or series of webinars in itself, but I think that context is important. We're going to try and look forward, but I think to do that, it's helpful to look back a little. So recap a few things. So given the huge increase in DB transfers in the aftermath of the pension freedom changes in 2015, and of course the complexity, the significance of the advice for customers, the FCA became increasingly interested and concerned, not helped of course by the widespread poor advice given to members of the British Steel pension scheme, which continues to have a very high adverse media profile. And we're going to come back to BSPS later. So in a consultation in summer 2019, the FCA said it estimated that customer harm from poor advice in this area could be as high as £2 billion per year at that point, which obviously made it a clear FCA priority. The FCA then did some suitability testing in 2017, which showed that, as far as it was concerned, suitability rate on transfers was just 48%, less than half, and that compared to a rate of 90% for the FCA's other file review work in other areas. Another review a year or so later had similar findings. So in late 2018, the FCA requested data from every firm with the permission to give this advice, and since 2019, the FCA has been carrying out a widespread industry-wide review, trying to identify firms exhibiting potential concerns, reviewing quite a large number of cases for some firms. This review, in some guise or other, I think is still ongoing, albeit now predominantly in the form of around, we think, 30 or so enforcement investigations against firms and individuals suspected of misconduct around DB advice, particularly given to BSPS members. And of course, Rebecca, if that wasn't enough, there have been 2 related and significant rounds of FCA rule changes. Perhaps just help if you could just recap those for us.
Yeah, absolutely. There have been. So as we're probably all familiar with, and we probably touched upon this in our last sort of series, from October 2018, the requirements for the APTA, the Appropriate Pension Transfer Analysis, and the Transfer Value Comparator, the TVC, came into force, effectively replacing the familiar TVAS that we're all used to. And then I guess more recently in October 2020, Policy Statement 26, which was the result of the consultation paper 1925, that introduced sort of further significant measures. So firstly, and probably one of the most important ones, was the prohibition of contingent charging, i.e. the requirement to now charge a fee irrespective of whether advising to transfer or to remain in the DB scheme, unless of course there are certain prescribed circumstances. And interestingly, we note that the FCA's concern, a valid one we think, between April 2015 and September 2018, 69% of firms recommended 75% or more of their DB pension advice clients to transfer, which is really quite high considering, you know, the bar that we're all familiar with. Another change, also quite an important one, analysis now must include any available workplace scheme as a possible destination for a transfer. Yeah. And an advisor must explain why this isn't recommended, you know, as applicable. I mean, this figure is probably even more stark. We note that the FCA's research suggests that between October 2018 and March 2020, only 1% of DB pension transfer values went to a workplace scheme, which is, you know, surprising given the value of some workplace schemes. We've also seen the introduction of abridged advice, which is a method of informing customers what their DB scheme could provide if retained. I don't think we've really seen much evidence of this taking off, but I guess we'll watch this space. There's also the requirement of abridged advice. The requirement for firms to submit to the FCA data on their activities and outputs every 6 months. And then more for individuals, there are now specific CPD requirements for advisors. So a minimum of 15 hours per year, including 5 hours from an external provider, which I guess would be us. So hopefully we'll be helping some of you to fulfill that requirement today. That might be useful. You can tick some boxes.
That's right. Yeah. No. Thank you for summarising all of that. Yeah. So perhaps unsurprisingly, this combination of intense FCA supervision, new rules, greater regulatory burden, more stringent requirements has had a pretty profound effect on the market, and over a reasonably short space of time. So the number of firms giving DB pension advice has shrunk significantly. We think that only around 20% of all advisory firms now have the regulatory permission to advise on pension transfers and opt-outs.
That's right.
According to data the FCA published a year or so ago, so it's a little old, but nevertheless it's interesting. The number of firms with permission to advise on pension transfers and opt-outs had fallen at January 2021 to just over 1,500, and that was down from just under 2,000 as recently as March 2020. We think that since the start of 2018, around 1,650 firms have exited this market. Nearly 1,000 left in 2020 alone. That was a 65% increase on 2019. Now, we know that in practice, most exiting firms seem to have not relinquished the permission altogether, but they've added a non-standard permissions application instead.
Yep.
And it's not just the advisor market that's shrinking. There's perhaps a related reduction, we think, in the number of transfers taking place. So there's some interesting data published not so long ago by LCF, which is it administers around 80 pension schemes. This is data in the public domain. So in the final quarter of 2020, 116 out of every 10,000 members requested a transfer value from those 80 schemes. That's around half the equivalent number from the autumn of 2017. And only 17 of every 10,000 members actually proceeded to transfer. And that's around a quarter of the equivalent figure from autumn 2017. So that's data from one administrator. So we have to be a bit careful. but it's perhaps illustrative of the trends that we're seeing in the market.
Yeah, well, I mean, it's certainly striking data, it would seem. And of course, as we know, there are other significant headwinds for advisors, which have doubtless contributed to the market shrinking. It's thought that the pandemic lockdowns depressed interest and activity in long-term financial planning, including pension planning, which I guess is probably quite understandable. From the 1st of April 2020, the FCA increased the FOS compensation limit from 150,000 to 350,000. And then, of course, we've got the ongoing sort of difficulties and uncertainty around PI cover in this area, including price increases, which are likely related to FCA and FOS attention. The FCA, I think, has said that it's engaging with professional and trade bodies, as well as PI insurers and brokers. I'm sure they appreciate the challenge here, and I think sort of the more open dialogue they can have with all relevant stakeholders can only be a good thing in this space, I think.
Yeah, I mean, I think they do understand the issue that they must do. I think they get criticised sometimes for not doing a great deal about it, fairly or unfairly. But we know from talking to firms that this is a problem, a significant problem for some of them.
I think it is.
Because the rules are such that you can't operate unless you've got this cover.
Absolutely, that's right. So it's tricky. It's certainly tricky. It's something to be ironed out, I think. So I guess the key question is, what does all of this mean for the market? And what the firms that are still active in the DB pensions advice market be thinking about at the moment?
Yeah, I mean, we've been painting with a stark picture, haven't we? So let's be more positive for a moment. So we know, Rebecca, don't we, from our work, that it is absolutely possible, perfectly possible, to give good advice on defined benefit pension assets, whether that's to transfer or to remain. I think the FCA does recognise, firstly, that the financial planning issues are complex and people do need expert advice. And secondly, the FCA recognises that a transfer is indeed absolutely the right thing for some people in some circumstances. So yes, they've been on the warpath, but in the FCA's view, only against firms giving poor advice. They want to chase those firms out and keep the good ones. And we are very clear from our work that the FCA does want a healthy market, a competitive, effective market with a decent number of firms giving this advice and doing it very well. So let's start with that positive thought. But yeah, nevertheless, in the short to medium term, the outlook is going to continue to be challenging, and will include a number of features. So first and foremost, heavy FCA supervisory and indeed enforcement activity. We don't think is going to ease in the immediate term. And of course, we've got the increasing possibility, arguably now a likelihood, of a formal Section 405 redress scheme for members of the British Steel Pension Scheme. I know we're going to come back to that a little later.
We will.
We mentioned earlier that the FCA's sort of thematic supervision project is effectively ongoing, and the FCA is also following up, it says, with every firm materially involved, it says, with providing transfer to BSPS members. Again, there's a possibility of redress scheme now, so we don't know exactly what that will entail, but it sounds like a lot of work. I mean, I guess we would say this, wouldn't we, Rebecca? But we would strongly encourage firms, if they haven't done so already, to have a look at DB pension transfer advice they've given in the past. Not necessarily all of it, depending on volumes, how confident you are in the quality of your advice for various reasons, but maybe a representative sample. So, of course, since we did this series before, the FCA has now published its own defined benefit advice assessment tool, the DBAT. Published that a year or so ago, and it's being updated for a British advice as well. So there's no requirement to use that tool as yet, anyway. I mean, who knows what's going to happen with the British Steel Scheme, but there's no requirement to use that tool as it stands today. But we think it's a good idea. We've used it pretty extensively, and we think it works pretty well. In that it helps you to separate different parts of the advice process into its constituent parts and evaluate them separately, which is helpful. It's easy to get information gathering, the advice itself, disclosure things all mixed up. So by segregating them out in the way that the DBAT does, you can evaluate things differently, which helps. And it means you can take an outcomes-focused approach I think the FCA is looking for us to take an outcomes-focused approach. Yes, ideally you dot all the I's, cross all the T's, have perfect observance of all the COBS rules at all times. Is that realistic? You know, possibly not. What's essential is the quality of the outcome for the customer, and is a good outcome demonstrable.
Yeah.
And we're going to come back to the debate in a lot more detail this time next week, I think.
Yeah.
So I guess our advice, if we're calling it that, to perhaps review your own past advice, I think is particularly pertinent for firms who advise on British Steel members. Although A, it's possible the FCA has already been in touch with you if that's you, and B, we may have a redress scheme coming anyway.
Yeah, that's right. And I think in our work, we're starting to notice examples of advice rated suitable by independent experts engaged by firms being the subject of complaints upheld by FOS. So that's something to sort of bear in mind. And I know this is or can be disconcerting for advisors and hardly an incentive to keep going. We also think this is a bit of a headache for the FCA, but I guess nonetheless we sort of must plough on. I think ultimately there is a view that the FCA's outcomes-focused approach that you were just talking about to reviewing advice via the DBAT tool is ahead of how FOS scrutinises complaints about DB pension transfer advice, I think ultimately. Yeah,
I think that's right. I mean, it's another example of, you know, an issue that's been out there for ages in terms of industry and indeed perhaps public concern that you know, the entirety of the regulatory infrastructure doesn't necessarily agree with itself all the time, which can be unhelpful. And of course, there's been another significant development, hasn't there? The autumn last year in September, the FCA confirmed its first periodic review of final guidance 17.9, which is the means by which firms are encouraged, if that's the right word, to calculate any redress due to customers who received unsuitable pension transfer advice. So, what are your thoughts on that one?
Yeah, well, it's an interesting one. You know, the FCA is obviously really sort of trundling down the path of reviewing advice, and you know, all the way to the end result really. And I think this is in line with a commitment to review the guidance at least every 4 years. And I guess we find it interesting that the FCA has done a huge amount of work to review or encourage firms to review whether the advice that they've given was suitable, but relatively little, we think, to review how firms are interpreting and applying FG 17.9. So they're obviously now looking at the whole journey, which is good. It may be that as it started to do so, the FCA is concerned that firms have not been applying the guidance as they believe it should be. Whilst the guidance is quite prescriptive, I think there is some scope for interpretation, particularly regarding accounting for future advisor charges on prospective losses.
That's right.
i.e. where the customer has not yet crystallised benefits. In its September announcement, the FCA stated its expectation that pre-retirement discount rate should be netted down to allow for ongoing product charges and regular advisor charges in percentage terms all the way to the scheme's normal retirement age. So that's sort of making some changes to some calculations. The FCA has said that it will consult on any proposed changes to FG 17.9, so I guess we'll just have to watch out over the next year or so and see how that plays out.
Yeah, I think that's right. I think you've made some really good points there, particularly around the FCA's done loads on qualitative advice, but has it looked at how firms have been calculating redress as a result? Have they been meeting the FCA's expectations in that respect? So yeah, that's a very interesting one.
Yeah.
So yeah, it's a tough environment for DB pension advice and advisors. There's no two ways about it, and I think we can reasonably expect the number of active firms and the volume of transfer activity to continue to fall, perhaps not quite at the same rate. But as we said, this is really important. We really do think there is a place for good advice on what to do with defined benefit scheme assets, and it is absolutely possible to do it very well. Not just here and there, but consistently. And we have seen firms doing it very well. Just one other thought, looking a little bit further ahead, and we're into the realms of speculation now, but yeah, we're coming hopefully towards the end of the pandemic. As you said earlier, is it going to become endemic soon? Hopefully. But you know, pension regulation just more generally may come into the spotlight a little more. You know, particularly as you know the economic effects this crisis for individuals and households can be more easily quantified. I think despite the efforts of all the regulators involved, best intentions, you know, the way pensions are regulated is a bit odd, you could argue, with different bits of it being regulated by different places. Maybe a view emerges that the existing regulatory framework for pensions is suboptimal. And you know, the idea of a separate sort of standalone regulator only for pensions, with zero accountability straight up to the Treasury, etc. I think that has been considered before. It may be that's revisited. Well, as I say, we're speculating now. I think a slightly safer bet, perhaps, is that winners from the COVID crisis, in the nicest possible way, probably include anyone involved in digitisation. So if you're in the RegTech business or AI, we've all been forced to use those tools. Of people have been living and working remotely. They're much more part of day-to-day life now, and they're going to be a feature of our industry for a long time to come, I think.
Yeah, that's right. I think there's definitely lots more developments ahead in this arena.
Indeed. Okay, if we could move on to the next slide, please. So I think now, Rebecca, we're going to consider in a bit more detail the more recent developments with the British Steel Pension Scheme and the FCA's Dear CEO letter to firms who gave advice to those members. Before we do, can we try and initiate our second poll question of the day, which is this. So, how would you describe the impact of the FCA's Dear CEO letter on BSPS advice and a possible redress scheme on your firm? So just the impact on your firm, would you describe it as significant, moderate, insignificant, or in your case, doesn't apply to you or you're not sure? So let's see what people think about that one.
I think it is. Oh, there we go.
Here we go. So a bit of a different set of results to the first one. A smaller number saying it's significant, only 5% for them as an individual firm. I guess we don't know why. Maybe that they're not impacted by it. It may be that they've already got to the bottom of any problems in that area. Around a quarter saying it's a moderate impact, just under a quarter, and just under a fifth or so saying it's insignificant for them. And for most of our audience today, over half, in their particular cases, they're not quite sure yet, or it doesn't apply to them.
Yeah.
What do you make of those numbers, Rebecca?
Well, yeah, interesting. So I guess we don't know the makeup really in that much detail of the participants, but I wonder if either some haven't quite got to grips with the letter yet, and sort of what the effect of it might be, or maybe some of them don't have quite a lot of exposure to the British Steel Pension Scheme members, perhaps. So.
Indeed. Okay, well, that's interesting and helpful. Thanks everyone for participating in that. So yeah, Rebecca, can you just take us through, remind us where we are with this BSPS situation and a possible Section 404 redress scheme?
Yeah, sure. So I think it's been sort of rumbling away in the background for a while now. The FCA has said that it's been considering a formal consumer redress scheme for British Steel Pension Scheme members, ensuring that this issue has retained a high profile. Of course, as we know, the FCA has come under huge political pressure with criticism, including from MPs, that it hasn't done enough to find wrongdoing and support members who should not have been advised to transfer out. I think largely the FCA's position so far to date has been that it's felt there hasn't been enough information to justify a redress scheme at this stage. So they've sort of been sticking with their approach to sort of intensive supervision, enforcement and enhanced engagement activities with British Steel members. We know that complaints from British Steel Pension Scheme members to the FOS have increased markedly since the FCA did some roadshows events in Swansea and Scunthorpe. I think there was a news item just out yesterday noting that the FOS has tended to receive around 20 British Steel Pension Scheme transfer complaints per month, but that jumped to 81 in November and 64 in December of last year. So I think it's now around about 750 overall. So just before Christmas of last year, the FCA sent a Dear CEO letter to all firms that gave pension transfer advice to British Steel scheme members between the 1st of March 2017 and the 31st of March 2018. So I think that sort of period spanned the time from which sort of British Steel pension scheme was closing up until sort of the new scheme became in force. And in this letter, the FCA reiterated its concern that from its work, the rate of unsuitable advice given to British Steel members is higher than it is seen for advice given to the members of other DB schemes, which is, you know, quite strange, really. That sort of population, you know, had a higher rate of unsuitable advice. It informed firms of the FCA's announcement that the FCA board has asked for a consultation to be prepared on a Section 404 redress scheme on the sort of pension advice given to members of the British Steel scheme. So the FCA is currently gathering further evidence and engaging with stakeholders, and it expects to consult by the end of March this year. The letter also signals the key point, I think this is probably of most interest, that under a formal redress scheme, firms who advised on British Steel transfers will be required to review that advice. And if that advice is unsuitable and resulted in a financial loss for those members, the firms will be required to pay compensation. The letter also reminded firms of their responsibilities to maintain adequate financial resources, including PI insurance. So I think it's really sort of setting the scene there.
Yeah, there's that PI cover thing again. Actually, the FCA gets a bit more specific, doesn't it, with some of these observations?
Yeah, it does. And the letter quotes an actual sort of British scheme, British Steel pension scheme specific email address for firms to enable firms to notify FCA immediately if they do not have adequate financial resources. And it really goes into detail, reminding firms that they should retain assets for a potential redress exercise, and certainly not to enter into any arrangements to remove assets from the business in anticipation or regulatory action or insolvency.
Yeah, I mean, firms have those sorts of obligations ongoing anyway, don't they, as applicable? But are there perhaps some sort of thinly veiled warnings in there?
Yeah, I think so. You can certainly read this as the FCA putting firms on notice that they will be taking a very dim view of non-disclosure of inadequate financial resources to deal with reviewing advice and paying appropriate redress to British Steel members. And I think they're perhaps taking an even dimmer view of any firm trying to sort of divest assets that could be used to reimburse British Steel members who had unsuitable advice. Those, I think, are very likely to be aggravating factors for any supervisory or enforcement action that the FCA considers or pursues against individual firms or those running the firms.
Yeah, I think that's right. And finally, the FCA says that firms should not apply to cancel their authorisation without first discussing their plans with them as well.
Yeah, it does. You know, there's a bit of an irony there. I mean, we've just been talking about the FCA's policy making and supervision being a driver of sort of market contraction as they try to chase the bad firms out of the market. And now they're warning firms, you know, not to do anything to escape their ready regulatory reach without talking to them first. But I guess we can all understand why the FCA doesn't want these firms to exit, and I think it's just making that quite clear to firms.
I think that's right. Yeah. And to these ends, the FCA has also sent out another information request to firms. Another one.
Yeah, they have yet another one. I think we understand the FCA has asked around 2,500 advice firms to complete a survey on their work relating to British Steel pension scheme as part of its pre-consultation research. Advisors have been asked to tell the regulator how many British Steel pension scheme clients they have advised on, the value of those transfers completed, the number of complaints they've received in relation to that advice. The survey also asks advisors whether PI cover they hold will cover any British Steel pension scheme claims. We know that some PI insurance providers have added exclusions to British Steel cases and even occasionally to all pension transfer advice. So, like you say, it's really sort of putting firms on notice.
Yeah. I mean, as you say, this issue has been rumbling on for a while, and I guess whether it affects you directly or not, whether you have British Steel advice cases in your estate or not, just the issue itself, it's kind of hangs over the whole sector, doesn't it? Whether you're directly impacted or not. So
It does.
as to these headwinds we've been talking about.
Yeah.
Okay, so my turn to ask you a similar practical question. So, what should firms who gave advice to BSPS members, particularly in that relevant sort of time to choose period of March 17 to March 18, what should they be doing? And might that answer depend a little bit on whether or not they did British Steel cases or whether they've had contact with the FCA about them?
Yeah, I think the answer will differ. So any firm currently in the process of reviewing past DB transfer advice as part of ongoing FCA engagement should certainly continue to do so and remain engaged with the FCA in any ongoing enforcement investigations or supervisory work. So sort of carry on as usual there. For firms not currently involved in sort of ongoing liaison with the FCA, they need to be aware that FCA will be making contact to understand more about the British Steel pension scheme advice they've given. So therefore, I think firms really should try and get on the front foot wherever possible. They really need to have a full understanding of the advice that they've provided to British Steel members during that relevant period. And by undertaking an audit in this area, try to get a handle on their firm's position and potential exposure to any liabilities in relation to this advice. We think the best way to achieve this, as we've sort of mentioned before, is obviously for firms to initiate a review of the DB pension transfer advice they've given to British Steel members during that period. Depending on the numbers involved, firms could perhaps start with a high-level assessment of their client files to sort of gather some detailed information to allow it to prioritise the most at-risk customers and then undertake a more focused risk-based review. As we've already sort of talked about, a good place to start would be to take a look at the FCA's DBAT tool. This is quite a useful tool with extensive associated guidance, which really sort of does, run through in quite a lot of detail how the tool should be used. And firms can use that when assessing the advice they've provided. As you mentioned, we'll talk about the DBAT tool during our next webinar, which I think next week. But I guess in our view, we think the FCA will certainly look more favourably upon firms who take the initiative, take a proactive, decisive approach to really understand their position in this area. Meanwhile, I think it's also imperative that all firms continue to handle any complaints that they receive in relation to British Steel advice, or any advice for that matter, in accordance with DISP rules. So as we know, DISP rules state that firms must handle complaints fairly, consistently and promptly, so firms must carry on doing that. And if the FCA has said that it will take action if firms are seen to take any steps that might deter their customers from pursuing a complaint or indeed referring a complaint to FOS. So, sort of be very careful with complaints coming through. And then, on the other side, firms should be looking to assess their current assets and financial position with regard to any potential liabilities. And I think it might be useful for firms to start having conversations with PI insurers to understand more about the cover they have in place, and I guess any of the effects of any exclusions to that cover. So, so I hope that's a helpful quick run through of that. I think we're got time. Maybe we'll move on to the next slide. It might be useful, I think, Peter, if we finish our session today by considering, given the context we've just been discussing, some of the key elements of how a DB pension advice process can be well controlled. What are the important things to pick out, do you think, given everything we've talked about?
Yes, indeed. Okay, so firstly, it's important to note that the FCA's expectations are, or certainly should be, proportionate to the size, scale, reach, nature, complexity, and inherent risk presented by any regulated firm. I think we've worked with some smaller firms. I think arguably the biggest danger in this respect for smaller firms is that they sort of allow themselves to exist in a bit of an isolated bubble with little or no exposure to any outside scrutiny. So firms may be happy with their advice, and indeed justifiably so. But a bit of independent validation, even if it's only in a relatively small sample of cases, is a good idea, particularly given the supervisory environment and the wider context for this advice at the moment, I think.
Yeah.
But of course, as a firm, the larger you get, the more advice you provide, the more customers you have. Oversight expectations proportionately increase. And at a certain point, which will vary from place to place, the FCA would expect a firm to have some kind of second line function to oversee the advice process and its outputs. So we think that should include reviewing the extent to which the advice process is actually being followed correctly by advisors, and that the controls around that take place and work properly. Perhaps more importantly, that those controls are meaningful. In other words, they do work as intended, and that's seen in the results of the advice reviews, and that those are positive. Obviously, the results of those reviews are important, but are they robust, and can the firm prove they're robust? Are errors being picked up, omissions being picked up, any poor judgments being picked up, and is the firm taking appropriate action, either in respect of an individual advice case, or indeed a bit more systemically, if there's something that could be improved about the advice process or the controls, for example.
And the FCA also expects firms to have identified any inherent features of its business model and activities that could drive poor behaviour or present obstacles to good consumer outcomes, and to have effective controls to address them. What are the important considerations here, do you think?
Yes, well, there's a number of important things. I guess firstly, we go back to our parked consumer duty principle and rules. Again, that's a webinar for another day, but there's that to be mindful of. That affects every firm with retail customers, which of course includes our population for these purposes. But going back to more specific issues, just for this market. So firstly, perhaps there's the obvious one, which is the charging structure. You mentioned earlier that contingent charging is now effectively prohibited, other than in certain prescribed circumstances. I think in any event, we've always felt that a non-contingent charging model makes it far easier to demonstrate that there are no undesirable motives behind advice. But again, being more positive from that, there's something else about this as well that I've always felt, which is that when this is done well, advisors they're not processing a transaction. They're selling their time and their expertise. And I've always felt that advisors should not underestimate the value of what they do. If you're giving advice on this and it's done really well, what you're giving somebody is nothing less than financial peace of mind for the rest of somebody's life, because we're going through their retirement. And that's true even if, say you've assessed somebody's finances and needs, you recommend little or no change to what they're currently doing. Even that is valuable if that's the right thing for them. So look at the charging structure. Related, of course, to that are controls around advisor remuneration. So a good rule of thumb is that the greater the extent to which an advisor's remuneration is linked to productivity, greater the degree of likely regulatory interest, and therefore the greater the controls needed to mitigate that. I think most people will be aware that the FCA is far more comfortable with incentives linked to quality rather than volume or productivity. So I think we still see firms, exposing themselves to risk a bit there. This next one I think is also important as well, and we've discussed this with firms. So we think that the prospect of ongoing charges post the initial transfer advice, which potentially could stretch for years or decades even into the future, that's obviously a commercial positive for firms, but it does represent a conduct risk for advisors to manage. So there's nothing wrong in principle with providing ongoing advice, but quite the reverse. Supporting somebody through their retirement through complicated decisions and monitoring investment performance is going to be very, very beneficial for some people, and firms deserve to be paid for that. But it is incumbent upon advisors to be able to demonstrate that the individual customer has a genuine need for that ongoing service, that they're going to derive value from it, and of course that the firms are actually providing that service. We see firms get into trouble because they they're charging customers for ongoing service, which either the customer doesn't need or isn't actually being provided.
Yeah.
I think also if you're a pension transfer specialist, by all means accept referrals from other places. You know, we see these sort of two advisor models where a pension transfer specialist receives a customer from another advisor who deals with some parts of their financial planning, and they ask the PTS to do this. Of course, that's fine, but make sure you're applying controls that allow you to apply the same standards to fact-finding, information gathering, disclosure requirements, etc., that you would expect of yourself.
Yes.
And also make sure, if you are working with other firms, to have a clear agreement between you that codifies who's responsible for what. Again, we see firms get into trouble either with other firms or with the FCA about that, and that's another consumer duty point, actually. There are expectations around that in some of the consumer duty rules.
Yeah.
Couple more things finally. So managing conflicts of interests is important generally, but particularly important we see in this area when firms are part of a so-called vertically integrated group. So, for example, if you're an entity giving defined benefit pension transfer advice, you may arguably be incentivized either explicitly or implicitly to refer customers to other entities within your group for other services, most obviously a DC product or ongoing advice or other services. Again, that's fine as long as you've got controls around to manage that conflict is being managed appropriately.
Yeah.
And also, we generally like to see that a second line monitoring function, again for firms that are large enough to warrant that, should have a program of activities and management information to look at all these types of issues, to the extent necessary and proportionate for that firm. Yeah,
no, that's important. You know, proportionality, I think, is one of the key things there, really. Now, I mean, we're sort of coming close to the end. There are a couple of questions coming through, but I think we probably can't escape this conversation without talking very briefly about sort of management information. Can you give us some good practice examples of some meaningful MI that DB advisory firms should collect and review?
Absolutely. So none of the things we can talk about are necessarily mandated. You know, there's no one-size-fits-all good answer, but we can certainly talk through briefly a list of things that we have seen firms do which work well and which the regulator seems to like. So one would be monitoring your sort of ratio of advice to remain versus advice to transfer. And where this works really well is where firms also apply a kind of an expected benchmark. So, you know, generally speaking, we expect X% in a steady state. We'd expect X% to remain, X% to transfer. We think that's a generally a good place to start, which is kind of an expression of risk appetite. So firms doing that goes down well. I've already talked about customers advised and in receipt of ongoing advice. So how many customers take that option, make sure they actually get the service that they're paying for, and you can prove that. That's really important. The level, proportion, number of pre and post advice checks, whoever's carrying those out, you know, firms should have an expected minimum and be able to show that they're doing that minimum. Obviously, the results of those checks, again, this works well when it's set against an expected benchmark. So we have a risk appetite such that we expect 90% suitability, 95% suitability, whatever it might be. 100% suitability is obviously the ideal goal for everybody, but you know, in the real world, what do we expect advisors to hit? Can we show that they're doing that? And are we doing risk-based monitoring as a result? So again, it's not a new idea, but firms that select carefully whose cases they're going to look at and you know, on what basis. Things like how long they've been with the firm, what the results of their previous checks, those sorts of things. Complaint volumes as well, obviously, just generally and for individual advisors. Also, can firms prove that where necessary, they will actually apply, you know, disciplinary measures even. So if your advice rate is poor, if your conduct is poor, most firms will have some sort of policy that equips them in principle to deal with that, but do they actually follow through on that? Can they improve it? That's important. And as we always say for these sorts of things, trends and all these things to monitor progress over time is what the ASA would expect, I think.
Very good.
There we go.
Thank you for that, Peter. I think that brings us to the end of the main part today. So it's now time for some questions. I can see we've had one or two coming through in the chat box. The first one, you know, we sort of talked about this, I guess. The FCA's actions have reduced the market significantly, as I guess we've mentioned, and pushed PI rates through the roof. The net effect on consumers has been to have had a shrinking pool of advisors and a massively increasing charges. Not sure if this is a shot in the foot when it comes to fair outcomes for consumers. You know, I guess that's an unintended consequence. As we mentioned, it's a tricky issue, the whole sort of PI insurance area. The FCA are aware of it, they're conscious of it. I guess we'll see how things develop. What do you think?
Yeah, I mean, I think you said, Rebecca, earlier, that this is the FCA's activity over the last 2 or 3 years in this area is as striking an example as you could wish to find of the regulator having power and being willing to exercise that power. It was clearly very concerned from 2015, 2016 onwards in what it was seeing. It's taken action. I guess the value and the effectiveness of that action is in the eye of the beholder. You know, we've been saying earlier that the FCA's aim, I think, has been to, you know, from its perspective, strongly encourage firms to do advice properly, and for firms unwilling or unable to do advice properly to exit the market. I'm not sure whether they've stated it as boldly as that, but I think we can agree that that's been their aim, certainly been their effect. So, as I say, it's been the eye of the beholder. I do come back though to this idea. I'm idealistic, but I'm hanging on to it because I really believe in it. That there is absolutely a place for this. The FCA doesn't want the whole market to close. It really does not. I guess you're right that there might be an unintended consequence of too many firms, from anyone's perspective, exiting. But the FCA wants firms to be active doing this and doing it well. I think that's really important. Yeah,
agreed.
There's another question which I was gonna cowardly ask you to answer, Rebecca.
Okay.
So we had a question about the DBAT tool. Should it only be used for advice given before October 2020? Are we still waiting for one that takes into account the October 2020 rule changes?
So we are waiting for one that takes into account the 2020 rule changes, but I think the only real difference there will be where you're looking to assess abridged advice. So the new tool will really cater for abridged advice. All the other rule changes around sort of charging and what the other rule changes, workplace pension scheme to be considered, as you know, you can factor that in when using the DBAT quite easily. The guidance itself, I don't think it will be much changed. And the guidance to assessing all of the information that's gathered by a firm and then going on to assess the suitability of the pension transfer, the existing tool will still facilitate that. And in fact, we have used that tool recently, well, I think sort of last year, to actually help assess live advice cases. So for advice that's being given now, so you can certainly use the tool now. So I wouldn't sort of put off if you want to sort of get going with it. I'd certainly start and just be mindful of any sort of particular areas with rule changes. Okay. So yeah, that's that. I
had a question. Go on.
Yeah,
sorry.
Go on.
I had a question I was going to ask you. So, how likely do you think it is that there will be a formal redress scheme, Section 404, for BSPS members, and you know what might that mean for the advice industry?
Well, good question. I think it's getting more and more likely. You know, now the fact that there's really the FCA is really publicly talking about consulting on a redress scheme. As we know, sort of the British Steel cases have been quite high profile for quite some time now. So I guess, you know, it's in the balance, but my thought would be that it's more likely than not. And I guess what this means for the industry is much of what we set out earlier, really, which is there's going to be a lot more scrutiny, a lot more reviewing of advice that needs to be done. And I guess the key really will be sort of tying up you know, review of advice versus complaints to FOS ultimately. Yeah, I think there will be some activity in this area going forward. But I guess, you know, the more firms get on the front foot now, the better.
Yeah, no, agreed.
I think.
Okay.
I had a question for you, I think. What might the impact of Consumer Duty initiative be on all of this? I know we talked about it very briefly earlier, and you know, we perhaps might run some webinars or sessions on this going forward, but what do you think the impact might be?
Yeah, so as I said earlier, our subject matter today is kind of an example of things which continue to be very important, things which will continue to generate a lot of regulatory interest as standalone topics in their own right, with a set of rules and guidance that apply specifically to that topic and subject matter area. So yes, we're all now existing in a world where a consumer duty is overwhelmingly likely to come. So I guess we've got to bear in mind they're draft rules at the moment, and nothing is instituted as yet, but it does seem overwhelmingly likely that at the moment the FCA is saying April 2023 there will be a new consumer duty principle to replace principle 6 and 7, that we're also familiar with, and a series of cross-cutting rules which apply to all firms with retail customers in a huge variety of areas, including value, communications, understanding what a good outcome actually is. I guess what we're saying to firms, and this idea I think applies reasonably well in different sectors and different parts of the financial services industry. If you do well all the things we talked about today, and we're going to talk about subsequent weeks in these sessions, if you're doing that well already, you know, you're going to be 90–95% of the way towards being able to demonstrate adherence to the consumer duty requirements anyway.
I think that's right.
And what might be involved is some repurposing, rearticulation of your infrastructure and your outputs. So firms that already do this well are much better placed, I think. But yeah, if you understand and follow the rules and guidance that's there for this, treat it as a standalone thing in its own right, which of course it is, then yeah, you can you're a long way to meeting consumer duty requirements, I think.
Fine.
We are running low on time. We've done that quite well, I would say.
I think we have.
So, our contact details are on the screen. I think I mentioned earlier we're going to be sending out a follow-up email to everyone who registered for this with a recording of this event.
Yep.
I think, are we going to advertise some of our other upcoming events as well, possibly? So that's next week's session.
That's right.
On the DBAT, and yeah, here's some more of our upcoming events. Oh look, there's one about consumer duty there as well. So yeah, thank you again for everyone who's joined us. We really appreciate it. We hope you found it useful and interesting.
Thank you.
We'll be doing a similar event this time again next week, so if you could join us for that, we look forward to seeing you there on the DBAT. Thank you once again, and see you soon.